Welcome back to the Deep Dive. It is Sunday, February 22nd, 2026. And today we aren't just looking at a standard portfolio update. We are looking at a crime scene or maybe a blueprint.
Yeah, I mean, it really depends on how you view the future of the American economy right now.
Exactly. We have this huge stack of 13F filings, shareholder letters, and macro reports. And they paint a picture of a portfolio reset that is so drastic, so absolute, that it kind of forces you to question the stability of the entire market.
It really is a burn the boats moment. Usually, when we analyze these massive institutional investors, we're looking for tiny nuances.
Like a 2% trim here.
Exactly, or a slight sector rotation there. We're trying to read the tea leaves to guess what they're thinking. But today, we don't need to read any tea leaves. The message is written in neon lights. We are looking at a complete demolition and reconstruction job by one of the most contrarian minds in Silicon Valley.
We are, of course, unpacking the latest moves from Peter Thiel, specifically his 2026 portfolio reset. And before we really get into the weeds on the data, I want to mention something for those of you listening.
Yeah, this is important context.
If you are trying to keep a pulse on the broader market valuation yourself, which you really might want to do after hearing today's numbers, to track total market temperature, welcome to search and download the iOS app Buffett Indicator from the Apple App Store.
It's a really useful tool for just getting your bearings, especially since Thiel's moves seem to be a direct bet against that very indicator.
Absolutely. And just a quick housekeeping note before we jump in. Full, deep value research reports can be found in the description links. All analysis today is based on publicly available sources and may be subject to revisions or differing interpretations.
Right. Things change fast.
Exactly. All contents from this channel is for educational and research purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions. If you want to access more advanced contents, welcome to subscribe on deepvalues.ai. We will share our latest researches and the most advanced AI agent tools for our contrarian friends. Don't forget to like this video. Much appreciated.
Okay, so with the disclaimers out of the way, I think we just need to get straight to the number that absolutely stopped everyone in their tracks this week.
The hook. The great liquidation. So on February 17, 2026, Peter Thiel's macro fund, Thiel Macro LLC, filed their report for the period ending December 31st, 2025. Total holdings reported. Zero. And just to be completely clear for you, the listener, this is not a rounding error. It's not, zero exposure to consumer tech. It is zero holdings in that specific reporting entity.
It is the financial equivalent of walking out of the casino and cashing in every single one of your chips. We aren't talking about shifting from software to energy. We are talking about a complete exit from the public equity markets within that specific macro vehicle.
The Magnificent Seven. The companies that have essentially carried the S&P 500 on their backs for the last, decade?
Yeah, easily a decade. And he's just wiped the slate clean.
So that is our mission for this deep dive. We're looking at institutional disruption. We have to figure out why he sold everything in one bucket and simultaneously what he is buying with extreme concentration in his other bucket, which is Mithril II.
Because he didn't leave the game entirely. He completely changed the board he's playing on.
And the lens we're going to use today to figure this out is actually a really fun one. We are going to take a Buffett-style value analysis.
The totally old school method.
Right, the old school method. Looking for moats, margins of safety, toll bridges. And we are going to use that framework to grade Peter Thiel's 0 to 1 new school portfolio.
It's a massive clash of philosophies. Old school value meets new school monopoly. So let's start with the exit. Let's look at Thiel Macro LLC. What exactly left the building? And more importantly, when did it leave?
Right. The timeline is super interesting. The exodus actually began in Q3 of 2025. That was kind of the first warning shot across the bow. In the third quarter, Thiel Macro dumped their entire position in NVIDIA.
NVIDIA, the company that basically became the entire stock market for a while there.
The absolute poster child of the AI boom. And they exited that position completely in Q3. The sources we're looking at suggest this was driven by a genuine fear of a potential artificial intelligence bubble.
Specifically the hardware side of it, right?
Yeah, the chips, the hardware. They also exited VistaCore in that exact same period. But here is where it gets really weird. In Q3, while they were aggressively selling NVIDIA, they were actually reestablishing positions in Microsoft and Apple.
So at that point, if you're an analyst watching this, it just looked like a standard sector rotation. Hardware is overheated. Let's move to the safety of software and services. Buying the steady legacy giants.
Exactly. It looked like a flight to quality, a defensive move, but still staying in the market. But then came Q4 2025, the period ending December 31st. The filing shows they liquidated everything.
Everything. Microsoft, gone. 49,000 shares sold. Apple, gone. 79,000 shares sold. Tesla, gone. 65,000 shares sold.
This is where I struggle with the narrative a bit, just from a traditional finance perspective.
Mm-hmm.
Because from a portfolio theory standpoint, this is pure heresy. You're supposed to diversify. You're supposed to hold the index over the long term.
Right. Time in the market beats timing the market. That's the mantra.
Exactly. If you are a macro fund, usually you hedge your bets. You buy puts, you short certain sectors. You don't just go entirely to cash.
Well, that assumes Thiel subscribes to modern portfolio theory, which he fundamentally doesn't. He has explicitly, on many occasions, called diversification a strategy for people who don't know what they are doing.
A hedge against ignorance.
Yes.
Yeah.
He views it as a hedge against ignorance. If you actually know what the future holds, or conversely, if you have a very strong conviction about what will not work, diversification just dilutes your returns.
So this isn't standard asset allocation. This is a very loud statement.
It's a tactical retreat. Think about the psychological difference between a hold-forever investor like Warren Buffett and what we are seeing right here. To buy Microsoft and Apple in Q3 and then turn around and dump them immediately in Q4.
It's aggressive.
It implies he saw something in the macro data. Maybe it was interest rates, maybe geopolitical instability, or maybe just pure valuation stretch. But whatever it was, it made him look at the board and say, the risk-reward ratio here is totally broken.
Now, the sources do mention, to be fair, that it could be a need for liquidity for private or political ventures. We know Thiel is highly active in those arenas, and we aren't taking a side on his politics, just reporting the facts of the filing.
Of course. And that is always a possibility with family offices and macro funds. Cash is optionality. But honestly, regardless of whether he needed the cash to fund a political campaign or buy an island, the signal to the market is the exact same.
Which is?
He believes cash is a better asset to hold right now than Apple or Microsoft. That is a heavy, heavy statement from someone with his track record.
It implies the upside for those massive legacy tech giants is capped, or that the downside risk is just being completely ignored by the broader market.
Precisely. He's not playing the index game. If the macro environment starts looking like a bubble, he goes to cash. He refuses to participate in what he might view as a giant game of musical chairs where he thinks the music is about to stop.
Okay, so that's the zero part of the equation. He zeroed out his legacy tech holdings. But that is only half of this deep dive, because while he was selling the past decade's winners, he was doubling down, tripling down really, on a very specific set of companies in his other fund.
Mithril II, GPLP.
Right. And this is where we really have to shift gears. We cannot understand the Mithril portfolio without understanding the Thielian doctrine. If you look at these companies through a standard Wall Street lens, they just look risky or expensive or, frankly, kind of weird.
You really have to look at them through the lens of his book, 0 to 1.
Let's break that down for the listener. The core mantra of that philosophy is competition is for losers.
Which sounds so incredibly counterintuitive to anyone who ever took Econ 101. We are taught from day one that perfect competition is the ideal state of capitalism.
Right. Supply meets demand, prices become perfectly efficient, and everyone is happy.
Everyone except the business owner.
Exactly.
Because in perfect competition, all of your profits are competed away. You end up with zero economic profit. Because the second you start making real money, a competitor enters the market, undercuts your price, and drives your margins straight into the ground. Thiel argues that to be truly valuable, to generate massive generational wealth, you must build a monopoly.
You need to be so incredibly good at what you do that literally no other firm can offer a close substitute.
Yes. And he distinguishes between two types of progress here, vertical and horizontal.
Right. Let's define those.
Horizontal progress is going from 1 to n. It's copying things that already work. It's globalization. It's taking a typewriter and making a slightly better typewriter, or opening another coffee shop in a city that already has 500 coffee shops.
And vertical progress.
Vertical progress is going from 0 to 1. It's doing something entirely new that hasn't existed before. It's the move from the typewriter to the word processor, or from the horse to the automobile. Thiel is exclusively interested in vertical progress because that is the only place where true monopolies are born.
So when we look at his portfolio, we are looking for monopolies. But the word monopoly is a loaded word. Regulators hate it. The public hates it. How does he actually define a creative monopoly? What is the checklist he's using?
He has 4 main traits he looks for. If a company has these 4 things, it has the potential to go from 0 to 1. The first, and arguably the most important, is proprietary technology. He says your tech needs to be at least 10 times better than its closest substitute.
Why 10 times? Why not just 20% better?
Because if it's only 20% better, you are just competing on features. You're in a dogfight. Someone else can easily catch up by tweaking their product. But if it's 10 times better, you escape competition entirely. You're offering something that literally feels like magic compared to the alternative.
Okay, so 10x proprietary tech. What is number 2 on the checklist?
Network effects. This is the classic Facebook or PayPal trait. The product must fundamentally get better and more useful as more people use it.
So a self-reinforcing cycle.
Exactly. It creates a moat that makes it impossible for a competitor to catch up. If every single person you know is on one communication network, a brand new network with 0 users offers you 0 value, no matter how elegant their tech is.
That makes sense. What's the third trait?
Economies of scale. And this is really where the modern software model shines. You have super high fixed costs to develop the initial code. You might spend hundreds of millions of dollars to build the software, but the marginal cost of adding the next user, it's basically 0.
Right, it doesn't cost anything to duplicate a digital file.
Exactly. This allows you to scale almost indefinitely without your costs ballooning. A service business, like a consulting firm, doesn't have this. To get twice as many clients, they need to hire twice as many consultants. Software just needs a few more servers.
And the fourth and final trait?
Branding. But Thiel treats this one very carefully. He argues branding is just the final layer. Having a strong, distinct identity that creates consumer loyalty is powerful, but you cannot build a monopoly on branding alone if the underlying tech isn't 10 times better.
Right, like Yahoo.
Right.
They had a massive brand in the late 90s.
Perfect example. Yahoo had the brand, but it didn't save them from Google's 10 times better search algorithm.
So that is our scorecard. Proprietary tech, network effect, economies of scale, and branding. Now, I want to take this exact scorecard and apply it to the absolute crown jewel of the Thiel ecosystem. Because we really can't talk about Peter Thiel without talking about Palantir Technologies.
Palantir is the anchor. It was co-founded by Thiel way back in 2003. Originally, the idea was to apply the fraud detection systems they had built at PayPal to stopping terrorist attacks for the intelligence community.
It is the ultimate 0-to-1 company in his eyes.
Totally. Because literally nobody else was building software for the intelligence community back then. Everyone else in Silicon Valley was building consumer web apps or standard enterprise accounting systems.
And looking at the financials now, in 2026, it has become an absolute beast of a company. But let's put on our Warren Buffett hats for a second. If Buffett were looking at Palantir today, stripping away all the AI hype and just looking at the raw business mechanics, what would he see? Would he see a moat?
I think he would actually see a massive moat. But it's a very different kind of moat than he is typically used to. Buffett loves switching costs. He loves businesses where it is physically or financially painful for the customer to leave.
He often talks about how he hates businesses where the consumer can wake up in the morning and decide to switch to a competitor just by clicking a button.
Like switching your car insurance online or buying a different brand of chewing gum.
Right. So where are the switching costs for Palantir?
Palantir has switching costs in spades. Think about what Palantir actually does. It isn't just a simple program you install on a laptop. It fundamentally integrates all of a massive organization's disparate data silos into one unified space.
Spreadsheets, legacy databases, live field reports, satellite feeds.
Everything. It pulls it all into one ontology.
Ontology. That's a word they use constantly in their materials. It basically means a dynamic digital map of the organization's entire reality.
Exactly. Once an entity like the U.S. Army or a massive global utility company builds their entire decision-making architecture on top of that ontology, ripping it out isn't just uninstalling some software. It's practically a lobotomy for the organization.
You are removing the brain, the operating system.
You would have to go back to being blind. You'd lose all that interconnected insight.
That is the toll bridge analogy that Buffett absolutely loves. You have to pay the toll to cross the bridge. In this case, Palantir is the digital toll bridge for an organization to actually understand and use its own data.
Exactly. And the financial data completely backs this up. The sources highlight what they are calling inexplicable growth, driven by their artificial intelligence platform, or AIP.
Inexplicable growth. That's a direct quote from the CEO, Alex Cartwright.
Ah.
It's pretty rare for a CEO to look at their own balance sheet and call their growth inexplicable.
It is rare. But in Q4 2025, their revenue growth was 70% year over year. Total revenue growth for the entire fiscal year was 56%. Karp calls it inexplicable because it's being driven by massive enterprise customers adopting these large language models in a secure environment faster than even Palantir anticipated.
They launched those boot camps, right?
Yes, the AIP boot camps.
Yeah.
They literally go to a customer, set up the AI infrastructure on their data in a matter of days, and show them immediate actionable value. That compressed the traditional enterprise software sales cycle from 18 months down to a week.
That 70% growth is just staggering for a company of this size. Usually, as you get bigger, the law of large numbers kicks in, gravity takes over, and growth slows down.
Okay.
But is it profitable? Because usually when you hear high-growth tech, you immediately assume it's a cash-burning furnace.
And that is exactly where Palantir surprises the old-school value investors. This company is a financial fortress. As of early 2026, they have $7.2 billion in cash and short-term treasuries.
$7.2 billion.
Sitting in the bank. And zero long-term debt. This isn't some startup borrowing money at high interest rates to survive another quarter. This is a bank vault. But the metric that really blows the mind, the one that the hardcore software analysts obsess over, is the Rule of 40.
Let's unpack that for the listeners who might not be software analysts. What exactly is the Rule of 40?
It's a standard heuristic used to evaluate the health of software companies. You take your annual revenue growth percentage and you add it to your profit margin percentage.
Okay, so growth plus margin.
Right. The idea is that there's usually a trade-off. You can either grow super fast and have low margins because you're spending on sales, or you can grow slow and have high margins because you're mature. But the combined number should ideally be above 40%. If it is, you are considered an elite world-class software company.
So 40% is the gold standard target. A company growing at 20% with 20% margins is a star. What does Palantir's score?
127%.
127%. That implies they completely broke the trade-off.
It is totally unheard of at this scale. It implies that they are growing explosively with that 70% revenue growth, while simultaneously printing cash. They have a 51% adjusted free cash flow margin.
So for every single dollar they bring in the door, they keep 51 cents in cold, hard cash.
Yes. That is a luxury brand business model disguised as enterprise software. It rivals the economics of things like global credit card processors or high-end monopoly pharmaceuticals.
Okay, so we have a super wide moat, we have incredible fortress-like financials, and a founder-led management team with Alex Karp. Buffett should be backing up the truck to buy this stock, right?
Well, here is the catch, and it is a massive one. The valuation. Palantir currently trades at 170 times forward earnings, and it trades at nearly 75 times sales.
Ouch. 75 times sales. That means if they took every single penny of top-line revenue and paid it out as dividends, it would take you 75 years just to make your initial money back. A traditional value investor would run screaming from that.
A traditional value investor absolutely would. Buffett strictly seeks a margin of safety. He wants to buy a dollar bill for 50 cents. With Palantir, you are basically paying $170 to buy a single dollar of future earnings.
It violates the core tenet of value investing.
But this is exactly where the new school value investor pushes back. They argue that the PE ratio is a lagging, almost irrelevant indicator when you have a Rule of 40 score of 127%. Standard metrics just break down.
Because the growth compounds so fast.
Right. Thiel is more than willing to pay the premium price for the monopoly because he fundamentally believes the explosive growth will persist long enough to justify the current price tag. He is betting on the power law, the idea that the ultimate winner takes all, and the winner is worth an almost infinite amount more than whoever comes in second place.
So Palantir is the proven monopoly in the portfolio. It's the one that has already been built. But now we need to look at the zero. The new bets.
The Mithril II portfolio. This is where we get to see what Peter Thiel thinks the next 10 years are going to look like.
This is where the deep dive gets really fascinating. Because while Thiel Macro was selling off all the legacy giants, Mithril II was concentrating almost half its total capital into one single company. 48.63% of the fund, to be exact. A relatively new player called Figure Technology Solutions, ticker FIGR.
This is a massive, massive conviction bet. When you put nearly half your entire fund into one single stock, you aren't just saying you like the company, you are marrying it. You are betting your entire professional reputation on its success.
So what exactly is Figure? Because I'll be honest, when I hear the word blockchain, I immediately think of crypto trading, Bitcoin, speculation, FTX collapsing, that whole world. But that's not what Figure does at all, is it?
No, not at all. And this is the most critical distinction we have to make today. We have to completely separate crypto, the asset, from blockchain, the underlying technology.
Okay.
Figure is using blockchain strictly as infrastructure, not as a casino for trading tokens. Their core business is actually incredibly boring. It's home equity lines of credit. HLOCs.
They are a mortgage lender.
They are a lender, yes. But they are a lender that has entirely rebuilt the back-end plumbing of how lending works. They use something they built called the provenance blockchain.
How does that actually change the business model, though? Why does a blockchain give them a competitive moat? Why couldn't they just use a massive, secure database like JP Morgan or Wells Fargo does?
To understand that, you have to think about the traditional, painful process of getting a home equity loan. It involves the originating bank, external trustees, manual auditors, endless legal paperwork, title searches, and fees taken out at every single step.
Right. You have to prove you own the home, pay for an appraisal, sign the physical line.
And all of this disparate data has to move securely between 5 or 6 different legacy institutions that all use different software systems that don't talk to each other. It's a slow, manual, highly expensive process. It routinely takes 45 days to close.
And what does Figure do differently?
Figure uses their blockchain to fully automate and standardize that entire chain of custody. The title, the land, the borrower's financial data, the loan itself. It is all minted instantly on the immutable ledger. By cutting out all of those manual human intermediaries, they reduce the cost of securitization by 85 basis points.
85 basis points, that's 0.85%. To a layman listening to this, less than 1% sounds completely tiny.
It sounds tiny, but in the world of institutional lending, 85 basis points is a massive landscape-altering margin. It is huge.
I guess this is a volume game.
Exactly. Lending is a massive volume game with razor-thin margins. Finding 85 basis points of pure efficiency is like a car manufacturer suddenly finding a way to get their steel for free. It's the difference between being mildly profitable and absolutely dominating the market. This is a classic low-cost provider moat.
Wow, so this connects directly back to the Buffett framework.
It does perfectly. Think about why Buffett loves Geico so much. Because Geico pioneered selling auto insurance directly to the consumer over the phone and later the internet, completely cutting out the local insurance agent and their commission.
That structural advantage made them the permanent low-cost provider.
Right. They can offer you lower premiums than anyone else and still make a healthy profit. Figure is doing the exact same thing to banking, but instead of the telephone, they are using blockchain to cut out the massive back office overhead.
So the blockchain isn't the product they are selling. The blockchain is just the internal tool that makes their actual product cheaper and faster.
Exactly. It's a pure efficiency play. And they are already seeing the concrete results. Their fiscal year 2025 consumer loan volume was $8.4 billion. That's up 63% year over year.
That's real scale.
And in Q4 alone, their volume was up 131%. They are scaling at this incredible rate because they can approve and fund loans in a matter of minutes or days, not weeks, and they can do it cheaper than the legacy banks.
But are they actually making money? Or is this another one of those fintech growth-at-all-costs situations where they lose money on every loan but try to make it up in volume?
No, they are highly profitable. Their GAAP net income was around $132 million. They are reporting an adjusted EBITDA margin of nearly 49%.
So it fits the Thiel model perfectly.
Perfectly. Proprietary tech, which is the Providence blockchain, creating an overwhelming economic advantage that competitors simply cannot replicate. Because the big legacy banks can't just easily switch to blockchain. They have tens of billions of dollars permanently sunk into COBOL mainframes and ancient legacy systems.
And there's a network effect component here too, right, with their stablecoin?
Yes, the YLDS stablecoin. As they bring more institutional partners onto this blockchain ecosystem, and they currently have over 200 partners, the overall value of the network grows exponentially. It becomes a vertically integrated marketplace for all types of credit. It is a true 0-to-1 move targeting a $2 trillion consumer credit market.
It is genuinely fascinating to see blockchain finally being discussed as a boring, efficiency-driving infrastructure layer rather than just a speculative asset to trade.
That is the maturity cycle of the technology. Thiel sees that happening right now. He's betting his fund that Figure will become the foundational infrastructure for the next generation of capital markets. If Figure wins, the stock ticker FIGR essentially becomes the Visa or MasterCard of the blockchain era.
Okay, so we have Palantir acting as the data operating system and Figure acting as the financial operating system. Now let's look at the other significant holdings in the middle of the second portfolio. There's a company called Black Sky Technology, ticker BKSY. It makes up about 32% of the portfolio.
Black Sky is exactly what Thiel would categorize as hard tech. It's space.
Satellites.
Yes. But not just launching satellites to take pictures of the Earth. We have had commercial satellites that do that for decades. Black Sky focuses exclusively on high-frequency, rapid revisit imagery.
What does rapid revisit actually mean in practice? Why do I need to see the exact same spot on the ground 10 times a day?
Most traditional Earth observation satellites are put in sun-synchronous orbits. That allows them to see a specific spot on Earth maybe once a day, typically at the exact same time, usually around 10 a.m. local time.
That's great for making a static map.
It's fantastic for mapping. It's terrible for military intelligence, because if you are an enemy army moving tanks or missile launchers, you just wait until 10:05 a.m. to move them, right after the satellite passes. Black Sky has built a constellation specifically designed to revisit critical global locations multiple times a day, from dawn until dusk, often with very short lag times between passes.
So if you're an intelligence agency or a defense department, you aren't just getting a before and after picture. You're basically getting a low frame rate movie of the target.
Basically, yes, you can track troop movements, monitor supply chain disruptions at ports, or watch construction progress on a military base in near real time. That capability is their moat. It's a literal tactical edge. And in a macro world that is becoming increasingly fractured, geopolitical, and unstable, that specific capability is essential.
The sources mention they have a $322 million backlog, mostly from international government contracts. That seems to validate that the demand is real.
Right. And that massive backlog is key because it provides clear revenue visibility over the next few years. However, unlike Palantir or Figure, BlackSky is a significantly riskier bet financially speaking.
How so? Just capital intensive.
Very. And they have debt. About $195 million in total debt right now. And their operating margins have historically been negative as they spend aggressively to build out the constellation. They are currently in the heavy investment phase, spending heavily on deploying their Gen 3 satellites.
Still, it's a land and expand play.
Exactly. They need to get the advanced hardware up in orbit, lock in these sticky long-term government contracts, and then eventually the margins should improve as the fixed costs are covered. But it's certainly not the cash-printing machine that Palantir is today.
So to summarize so far, Palantir is the mature, cash-rich monopoly. Figure is the highly profitable, rapidly emerging monopoly, and BlackSky is the hard infrastructure bet that is still proving its long-term economics.
Correct. BlackSky is a structural bet on global instability requiring better, faster eyes in the sky.
And then we have the smallest of the major holdings, which is about 19% of the portfolio, a company called Invivyd, ticker IVVD. This is a pure biotech play.
And this is a really fascinating turnaround story. Invivyd works on engineering advanced antibodies for respiratory viruses, specifically things like SARS-CoV-2.
We have seen a lot of biotech companies absolutely crash and burn post-pandemic. Once the initial wave ended, the market for COVID drugs collapsed. What makes this specific one a Thiel stock?
It's their platform approach. They aren't just a traditional biotech trying to blindly find one blockbuster drug. They have built a proprietary integrated platform that radically speeds up the entire discovery to clinical timeline.
How does it work?
The whole idea is to engineer antibodies, like their product Pemgarda, that can proactively adapt to rapidly evolving viral variants.
So instead of constantly playing catch-up with the virus, waiting for a new strain, and then starting from scratch, they have a systemic platform to design and test countermeasures faster than anyone else.
That is the 10 times better claim. Traditional drug discovery takes years of trial and error. Invivyd is trying to systematize it and do it in months. And financially, they have made some very serious moves recently to survive.
What did they do?
In late 2025, they aggressively slashed their cash burn rate, reducing R&D overhead expenses significantly, and they managed to raise over $200 million. So they have a solid cash runway now. It's a speculative value play. If the platform actually works as intended, they basically hold a monopoly on speed in the antibody space.
Wow. Okay, so we have covered the entire reset, the exit from the legacy giants, and the highly concentrated entrance into these four bets. Palantir, Figure, BlackSky, and Invivyd. I want to synthesize all of this now. I want to go back to our Buffett versus Thiel comparison framework.
Let's do it. It's the best way to process this.
If we look at this 2026 portfolio as a whole, how do the two investing styles actually compare? Let's start with moats.
Buffett fundamentally wants physical scale and consumer brand. He wants the physical railroad tracks that go through the center of town, or the Coca-Cola brand that every person on Earth recognizes. Thiel wants digital network effects and proprietary technology.
So he wants the invisible railroad tracks.
Exactly. The invisible railroad tracks of enterprise data, which is Palantir, or the immutable blockchain ledger, which is Figure. But the underlying economic principle is exactly the same. Protect the castle. Both men are entirely obsessed with pricing power.
What about diversification?
This is where they diverge the most in actual practice. Buffett famously says, keep all your eggs in one basket, but watch that basket closely. But if you look at Berkshire Hathaway, even Buffett holds a massive basket. He owns Apple, he owns major banks, energy pipelines, consumer packaged goods, he owns dozens of different stocks.
And
Thiel is practicing radical concentration, putting nearly 50% of a major fund into a single, relatively small-cap fintech company like Figure. That is a level of conviction that goes way beyond traditional value investing. It's founder mentality investing. It's saying, I know for a fact this company will work, so why on earth would I hedge my bet with inferior companies?
And finally, valuation. The price you pay.
This is the biggest philosophical divergence. Buffett absolutely demands a margin of safety. He wants to buy low so that even if his thesis is slightly wrong, or the market turns, he doesn't lose his principle.
Rule number one, don't lose money.
Right. Thiel, on the other hand, chases pure growth scalability. He honestly doesn't care if Palantir looks optically expensive today at 170 times earnings, because if Palantir actually becomes the base operating system for the entire Western world's military and corporate infrastructure, that PE ratio will look unbelievably cheap in hindsight.
He's betting everything on the power law.
Yes. He pays the monopoly premium upfront.
But despite all these differences, there is some serious common ground, isn't there?
Absolutely. At their core, both men passionately hate competition. They both want to own companies that completely control their own destiny. They both demand high structural margins. Honestly, Palantir actually fits the Buffett business model beautifully.
It's cash rich. It has a totally sticky product. It has incredible margins.
It fits everything perfectly except for the current price tag.
It's like a Buffett company that happens to be priced like a Thiel company.
That is a great way to put it. And Figure fits the classic Buffett model of the low-cost provider taking over a sleepy industry. So while the underlying technologies are very new school, the actual economic physics they are trying to exploit are quite old school.
So bringing this all together, what does this actually mean for us? What are the key takeaways from this entire deep dive that our listeners can apply?
I think there are three main lessons we have to distill from these filings. First, monopoly over diversification. Thiel's 2026 portfolio is a complete, unapologetic rejection of being average. He is not trying to beat the S&P 500 by 1 or 2% a year.
Stepping off the track completely.
He is trying to find the very few companies that are entirely detached from the standard macroeconomic cycle. He believes you should concentrate your capital in the very few things that will truly change the structural reality of the world, and just ignore the rest.
Second takeaway.
Blockchain as infrastructure. We really have to stop thinking about blockchain primarily as crypto or digital gold or a casino. Figure actively proves that the real massive economic value is in back-office efficiency. Cutting out middleman costs, removing auditors, speeding up transaction settlement. It's boring, but it is incredibly profitable.
It's plumbing, not poker.
Exactly. It's the new plumbing of finance.
And the third takeaway.
Data as an operating system. Palantir's financials prove that mission-critical integrated software can command absolute luxury margins. If your software is indispensable to how your customer literally understands their own business, you have infinite pricing power. And pricing power is, and always will be, the ultimate indicator of a generational business.
It's a very compelling argument. It really forces you to open up your own brokerage account, look at your portfolio, and ask yourself a hard question. Do I own any actual monopolies? Or do we just own a bunch of decent companies that are constantly competing with each other for increasingly thin margins?
It raises a really provocative final thought for everyone listening to mull over. Think deeply about what Peter Thiel sold. He sold Apple and Microsoft. These are the undisputed champions that defined the entirety of the last decade. They were the ultimate winners of the smartphone era and the cloud computing era.
And he took that capital and bought the companies building the foundational infrastructure of the next decade.
Exactly. He bought the AI data operating system in Palantir, he bought the blockchain financial rails in Figure, and he bought the rapid space-based intelligence network in BlackSky. So the question for you, the listener, is this. Are you holding on to the winners of 2015 simply because they feel safe and familiar today? Or are you actively looking for the toll bridges of 2030?
Because the toll bridges of the future aren't made of concrete and steel anymore. They're made of proprietary code and integrated data.
They absolutely are.
That is a very powerful question to end on. Are we investing looking in the rearview mirror, or are we looking through the windshield?
And hey, if you want to check the macro temperature of that windshield right now, remember to check out that Buffett Indicator app we mentioned.
That's right. Search Buffett Indicator on the Apple App Store. It's a great tool to have in your pocket. And don't forget to check out deepvalues.ai for the advanced AI tools and full research reports. Thank you all for listening to this deep dive into Peter Thiel's 0 to 1 portfolio reset. It has been a truly fascinating look at how a master strategist is positioning his chips for the future.
Thanks for listening, everyone.
We'll see you on the next deep